Hello everyone. Welcome to another episode of How to Trade with Less Than $5,000. This is episode 6. My name is Rony Nehme. I'm Chief Market Analyst at Squared Financial. My team and I also run an education program to teach aspiring traders how to become successful, open an account with Squared Financial, and then we coach them along the way during their trading journey. So let's start, share the screen. Okay, so this episode is about how to think like a pro, okay? Trade like a pro, okay? How to think like a market maker. We're gonna go through skills versus luck, and finally, chances and probabilities. Okay, so how to think like a market maker. We all know that the Forex market has all kinds of participants, right? Governments, banks, financial institutions, individuals, retail, such as us. But the top of this food chain are the interbanks, right? We want to know what the market makers are. Interbank market is a network of international banks operating in financial centers around the world. Okay, so there's about a dozen of them. Deutsche Bank, Citibank, Goldman Sachs, Royal Bank of Scotland, JP Morgan, Barclays, and many others. Of course, there are hundreds of other smaller international banks and financial institutions that trade alongside the top banks. Okay, so they all contribute to the liquidity, but they don't have the obligation that a market maker has, okay, or an interbank has, one of the big banks, which is to make a market. So what is a market maker? A market maker, the name is self-explanatory. So a market maker makes a market, okay? The market maker has to quote a two-way price, a bid and an ask. He or she is an employee at one of those big banks. Okay, they have to maintain trading operations. Why? To provide liquidity to the markets. Okay, so market maker on each pair has obligation to set bid and offer prices with minimum ticket of 1 million units. We all know that a standard lot is 100,000. The market maker has to quote a price. Minimum ticket is 1 million. In other words, 10 lots, right? So unit of a currency. So it could be US dollars, euro, pound, the currency that the market maker, because what happens is at the interbank, they specifically choose market makers for each instrument, for each currency pair. Okay, so second commitment or second obligation a market maker has is to commit to accepting deals at these prices. Okay, and finally takes the resulting exposure onto their own book. Okay, so they have to commit to accept deals at these prices. They can't just put a price out. They have to put a bid and an ask, of course, right? With a reasonable spread. They can't put 118.01, for example, and 118.70. They have to put 118.01, 118.03, 04, 05. Okay, and then they have to commit to accepting these prices. Of course, if they're a buyer, there would be their size on the bid would be much higher. Okay, and if they're a seller, their size on the offer would be much higher. However, the minimum ticket is 1 million, and they have to take the resulting exposure onto their own book. Okay, so if I'm buying and I'm buying from a market maker, they take that risk, even if they think that this market is going up. Okay, so, but of course they have inventory, and don't worry about them. They're not going to lose money. They're in it for the profits as well. Okay, so imagine there's a big move, right? Event driven. Something happened causing a lot of sell orders at the same time, for instance, on Euro USD. And imagine you are long and want to get out of your position fast, but you can't find any buyers. Well, this is the market maker's job, is to provide this liquidity so that not everybody rushes for the same offer or the same prices, and there is no sellers, because nobody thinks that the market it's all about supply and demand. So when there's much more buyers and not enough sellers, that's when the market makers have to step in order to provide this liquidity. Okay. So the role of a market maker then is to provide enough liquidity at reasonable prices, just like we said, to minimize a one-sided market. Okay. Now, obviously, there are no regulators. No one's watching them. No one will slap them on their hand if they don't, commit to the prices that they show. Okay, but if they keep doing it, they're going to lose business. Okay, they're going to lose the business of all these smaller international banks that who deal with this market maker. For example, let's take a small example. SquaredFinancial is a broker. We deal with many liquidity providers. Liquidity providers, i.e., banks, okay, international banks. Probably one or two of them are interbanks. For example, let's say we specifically deal with JP Morgan. So on the platform that you see, you're going to see a quote, a bid and an ask. We will take the best bid of all the liquidity providers that are quoting their prices, and we will put it on the platform, and we will take the best offer, and hopefully we will have. That's why the spread is not always fixed, but it's variable. We, for example, if we look at the platform here, let's switch to the platform very fast. If we switch to the platform here, we can see that on the Euro USD, for example, the spread is almost 12 or 1.2, right? So the spread is extremely tight. Why? Is because we have many liquidity providers, but look how it changes from time to time. For example, here the spread it says here 13. Okay, so now it's 12, right? So this is a quote. This is a bid-ask quote, and you will see the bid-ask quote of our own liquidity providers. Okay, which obviously we don't see the size. We can see the size, but there is an extra. This is an extra step, the market depth it's called, but we don't have the information that most of the banks or most of the bigger banks, the top of the food chain, have. Okay, so that's an advantage that they have. All right. So let's say, for example, that they have to take risks sometimes. Okay, but they do lose. Okay, of course they do. Of course they lose money. All market makers or all market participants lose money from time to time, just like the rest of us. Okay, but we all have our bad days, right? But trust me, they are the best of the best. These guys are not normal or are not, these guys have so much experience. These guys have been handpicked, chosen by their employer to be where they are, and to make their first obligation, obviously, is to make their employer money. Otherwise, they'll be fired, they'll be replaced just like that, right? So if they're trust me, they're making tons of profit for their employer. So they are good, okay? And they speculate, just like the rest of us, using the bank's money, something called proprietary trading, or prop trading for short, okay? So we know these guys are the best and they are profitable. Otherwise, they wouldn't be where they are, right? So we need to figure out what it is they're doing, okay? Is it luck? Is it skills? I personally don't believe in luck. So if they're there for many years and many, usually their salaries is extremely high. Their bonus at the end of the year is extremely high. And some banks even buy these guys they buy from each other. And they know this, for example, person is a very good market maker, and they're willing to buy this person for a very hefty price. So obviously these guys are the best. So why am I telling you this? I'm telling you this because I want you to think like a market maker. Sure, we don't have the information that a market maker has. Just like I said, we don't see the order flow for example, we don't see the order flow that he has. He has a book of clients, right? Don't forget, his obligation is to fill orders for his or her clients. So they have a book of clients, and they see the order flow of all their clients billions of dollars, okay? So coming in, right? So they see if there's more buyers, more sellers. So that's a very important tool that we do not have. However, we have a visual interpretation of it, okay? And what is it? The charts. Okay, so the charts is, in my opinion, a visual interpretation of how the market flow is going, if you know how to read it, of course, and if you can understand how it works. Okay, so let's see what the market maker has as an advantage. So they see huge flows of FX transactions, which we don't. They price to attract orders in one direction, right? So yes, you can say this is manipulation, but they're obviously there to make money. So they're going to do everything in their power to actually turn a profit, right? So they price to attract orders in one direction. Meaning, let's say I want to sell, I'm a market maker, I want to sell, I can place big bids on the bid, right? To show that there is a lot of buyers in order for people to see this information, because some people have access to this information and start buying from the offer. And what happens is I'm sitting on the offer selling, right? So I'm getting what I want at the end of the day. So yes, they can price to attract orders in one direction and they make significant profits. Okay, obviously they make significant profits. We can make significant profits as well, but they have tools that we don't. However, like I said, we have to think like a market maker, and we have the charts to help us, figure it out, or at least try to read what's going on in the market. Try to read what's the flow of the order flow. So if we learn how to read charts, understand all the details that we see, the market is supply and demand after all, right? Just like I said. So high demand, low supply, market goes up. High supply, low demand, market goes down. So sometimes a simple candle, just like the one you see on the screen, can tell us if, for example, a big wave of buyers just appeared and possibly a reversal is about to happen. Like, let's say the price is going down and now a big wave of buyer just stepped in, a reversal is about to happen. Okay, so a surge in price is about to happen. We don't, I'm not talking about scalping here. I'm not talking about, yes, the market maker can also obviously make the spread, right? If they have a lot of order flow, all they have to do is match buyers with sellers and make that spread all day long, and they'll make money, right? They won't make as much as if they take additional risk. However, they still make a lot of money. So we can't do that. A lot of people try to do it. We call it scalping in retail trading. However, I personally tried it a long time ago. I failed at it miserably, so I do not recommend it. You can also, try it on your own with maybe a small amount of money. It's extremely hard because we don't have the information that they do. So that's why I recommend more swing trading, just like we spoke of yesterday. Swing trading is more a style that fits a retail trader because of the information that we have. We have to also work with that. Okay, so we have to work with that. However, we have to think like a market maker. So sometimes, as I said, a simple candle, just like this one here, for example, this one here tells us that the market was going down and all of a sudden a big wave of buyers stepped in and the price ended up going back up a little bit. However, we see that tail, if you want to call it, or wick. Okay, this line here proves to us that there was a big buyer. We call this candle a long tail down. There's a long tail down, and usually this is a sign of a big wave of buyer coming in. And most probably, again, last time we spoke about chances and probabilities yesterday. So the probability here is higher than that the next candle is going to be a green candle. Okay, the next candle could be an hourly candle. Of course, if we're swing trading, we're looking at an hour chart or 4-hour charts for confirmation. Okay, so that's how I personally trade, and that's how I coach my students to trade. Okay, look at the 1-hour chart, 4-hour chart for confirmation. If you're trend trading, we look at the 4-hour chart, daily and weekly for support and important support and resistance levels. So don't try to speculate on gut feeling like most retail when they open their first trading account. I'll tell you how new traders think. I've seen it so many times. Okay, so price goes up a lot. Okay, so and they think, oh wow, look how price it's so high. It's so high now. It's got to go down. They sell. Okay, or the market's going down. Oh my God, look at the price. It's so cheap now. I've never seen the pound at these prices. You have to buy at these prices. They start buying. These are buyers, gut feeling buyers. We all started this way. These educational webinars are here to help you not do these mistakes, even though most of us do. But the problem is most of us do it so often is that we don't learn from these mistakes, and we don't start thinking like a pro. We don't start thinking like a market maker, and we end up giving up. And that's why the failure rate in this business is over 85%, right? Over 85% of retail traders fail, not because they lose money, is because they consistently lose money, ending up and give up at the end. All right, so we give up instead of learning and improving ourselves. So these webinars will help you maybe, hopefully, bypass that stage and directly get it into your mindset. Okay, that I want to think like a pro. I don't want to think anymore. The price is up. Let's sell it. It's too high. There's no such thing as it's too high. There's no such thing. It will go higher. Trust me. It might work in the beginning, right? Beginner's luck for new traders. However, it's also why, as I said, 85% of retail traders lose money and end up giving up. Okay, so think like a market maker. If a price is up so much, it crossed the critical resistance that we identified before based on previous behavior, right? So we drew the resistance line, okay? This is how a market maker would think, and this is how I want you to think. If you drew a resistance line and the price crossed that resistance line, there's so much buying, there's so much going on that the price crossed that resistance line on high volume, right? The high volume is the surge, is the catalyst, is the confirmation for us. So we crossed that resistance line, the resistance line on high volume, and it is not going any lower. How do we know it's not going any lower? Because every time it goes down, more buyers come in and end up pushing it higher. So higher highs, higher lows, right? So it's bouncing back up. So this resistance line, which is obviously now turned into a support because we see that the price is going back to it and boom, going back up, meaning it's not going up, but there is higher chances that it goes up. Okay, we're going to look at a few examples now. So price is so high it can't go any higher is no one's logic but an amateur. I used to trade for years, and I've seen all kinds of traders, and trust me, we all do it. Even with my experience, sometimes I'm so tempted to say, oh, the price is so low, it can't go any lower, I'm going to buy it here. Okay, sometimes it works, but the problem is with most traders, and I've seen it even with clients, I've seen it with so many people, is that they start buying and then it goes lower, they buy again, and it goes lower, they're adding to this losing position, right? Because if you were willing to buy at, let's say, 110 and now it's at 109, wow, this is even a better price, I'm going to buy more, 109, 108, and you're going to tell yourself, how low can it go, right? And you probably will make money from time to time, and this is a negative reinforcer. Why? Because you will keep doing that every time. This is a mistake. This is not supposed to make you money, but if it does, it's a negative reinforcer because it will teach you to do it all the time until one day the market doesn't go back your way and you blew up your account. Remember, we're using leverage. We try to work with very low risk parameters. However, the leverage sometimes, yes, it gives us the power. The power of leverage gives us additional profits, but it also is the tool that most people lose money because of it. All right. So if you're not losing leverage, if you're not using leverage, still, if you're going, this is called contrarian trading. So if something's going down and you keep buying and buying and buying, by the time it goes back up, you lost so much time. This is called an opportunity cost. So this is also, you're waiting. I've seen so many people, years. I have clients that have been holding position for years, because they're not using leverage, they say to themselves, okay, I'm not taking any risks, right? Well, wrong, because all this time that your money is stuck in these positions and you're waiting years. I know people who have been holding gold for years now, waiting for it to come back up, and now they just turned the profit because gold is almost at record highs, right? So they silver as well. They just turned the profit after 3-4 years of waiting. They turned a profit that they were supposed to turn in a 1 month trade. So all these years opportunity cost. They're happy. They closed the position with a gain. However, you might as well not trade because it's not worth it if you're going to turn, I don't know, let's say they made 10%. They made 10% over a 10-year period. I don't think this job is about making 10% over a 4-year period or a 3-year period, right? Okay, so let's again, this slide is about skills versus luck. So is this skills or luck? I obviously think it's skills. So I was telling you a story that I used to trade back in 2005, 2006 on a trading floor similar to prop trading it was. So I was trading for a bank's money. I was trading the bank's money. And I was sitting next to this guy. His name was Matt. And this guy would never have a negative day, ever. We all have negative days. So there's something wrong when you don't have a negative day, right? We all have bad days. And the way prop trading is set up is you have a risk, a daily risk. And if you go through that, if you lose that risk parameter that you have, you're out. Your software just kicks you out. You can't trade anymore, right? So in order for you not to revenge trade and be angry and trading angry, so they want you to just leave, go home, come back the next day, fresh new day. Okay, so this guy never got, we called it shut down. When you're shut down, it means that you just lost your risk for the day and you have to stop trading, so you're shut down. This guy, Matt, never got shut down. So I was like, Matt, I was sitting next to this guy. I said, well, what is your secret? How do you do it? And he says, you know what? I used to trade in a way, and everything used to happen. Like every time I buy, the market goes down. Every time I sell, the market goes up. So I started doing the opposite, and I started making money. And it was actually a true story. And the thing is, he started doing the opposite because he was thinking like a new guy, like an amateur. And by doing the opposite, he started doing what the pros were doing. Okay, I'm not recommending that you do the opposite of what you think, but this guy started thinking, okay, what am I doing wrong? I'm obviously choosing the wrong moves. Okay, every time I think, okay, this is gonna go up, let's buy, it goes down further. So from now on, I'm going to, instead of switch my buttons, instead of have a buy sell button, I'll put a sell button instead of a buy, etc. Okay, and vice versa. Okay, so think like a market maker. Okay, so let's before we go to the this is the last of the PowerPoint slides. So, but let's just look at some charts. We have, how long we have? We still have 5 minutes. So let's look at some charts. Okay, let's look at, for example, the Euro USD for today. Okay, this is perfect, right? This is exactly what I was talking about. Okay, look at. I'm sorry, I think you can't see my chart, right? Ooh. Okay, I'm sharing the wrong screen. I'll fix that. Stop sharing. Screen sharing. Chrome. Share. And chart. Still not working. What am I doing wrong? Every day, every time there's a technical problem, and I trained on that software, but I don't really like it anymore. Okay, stop sharing. Let's share the whole screen. or even though I have two screens, I still can't figure it out. Okay, so the entire screen. Here we go. Does that work? Yes. Okay. So now we're sharing the chart. So I'm sorry about that, because obviously last time I was showing the software, the platform, I was showing to see the spread, and it wasn't really sharing, right? Okay, so we'll fix that. I'll show it to you again, the platform, but let's look at a few charts here. So this is the Euro USD, okay? This is a 4-hour chart for swing trading confirmation. I drew this critical resistance line here that you see right here, the red line. Okay, why? Because it went to it. It's almost at 119, right? But it's not 119, it's 118.90. By the way, when I draw a resistance line, I never put it on top. Okay, I'm going to zoom in so you can see. Okay, so I never put the resistance line on the top here of the wick, what we call a wick, or the tail, not the tail, it's the line that you see above the candle. Why? It's because of the volatility that caused that. I need to erase it. Let's say this is I don't know, let's say it was so volatile. We see that in stocks a lot, volatility, and in stocks you would see a long wick, and you can't just decide that this is a resistance level, because the volatility caused that wick and not actual buyers or sellers. It was probably panic buying, panic selling, or just one buyer swiping offer because there is not enough sellers. Okay, and so I put always the resistance line on top of the candle, and then if it matches with another second one and third one, then I draw my line. Okay, let's zoom back up. Okay, so this is my critical resistance. The Euro USD went above that. Okay, broad dollar weakness. The catalyst obviously was the tensions between US and China on Huawei. Okay, and it's broad dollar weakness now. All the even cable is going up. The Canadian dollar is going up. Okay, so it, regardless of the fundamentals, we see here that the Euro USD crossed our critical resistance level. Okay, once it crossed the resistance level, I started reading news yesterday, last night, this morning as well. I was reading news. Please go to them. Every single analyst is saying, let me read something for you. This analyst here is on FX Empire is saying this has to go back down. Okay, this is a it lost steam. This is a crowded market. This is a crowded market, meaning it's gone so much up that it has to now go down. This is what the analyst is saying. Okay, I'm going to go do it yourself, do the research, go on multiple other websites or multiple other, let's say, Daily FX, FX Street, whatever, and see what the analysts are saying. And I bet you most of them are thinking, this is too high, it has to go down. And this is not the right mindset. In my opinion, after I cross the critical resistance, I don't want to sell it. Why would I want to sell it? What if it goes higher to 120, 121? Remember, we trade with our back, with a defensive line. I want my back against the wall. I don't want to sell or to buy something and not know where I will put my stop loss, or where or how high can it go. So I don't see how high can it go. Let's look at a daily chart to know, okay, or to not know, but to at least get an idea of how high it can go. Okay, and I don't see, I don't see any resistance levels around here at all. The next resistance level I see is around 21 or 1.2060. So there is a higher probability, especially that we look at the 4-hour chart here, and I don't know if you noticed what I noticed, okay? But after it crossed, it didn't come back down. It's not even retesting the resistance level. So obviously, buyers are just piling up here, and this is called, these candles here are called a consolidation, right? So unless something happens today, we look at the calendar, of course, just like we spoke of yesterday. Unless something happened that attracts sellers, so a fundamental catalyst that will attract a lot of sellers, I don't see this going down. Okay, the opposite is going to happen. Is this, and let's go ahead and do a trade. Okay, on the Euro USD. Okay, so this is the Euro USD. I'm going to buy right here, let's say half a lot. Okay, so, and next week, oops, again, this is a wrong demo. The demo accounts only last for a few, I think a month, and every month I have to open a demo account. So you know what I'll do is I'll do it on my real trading account, on my trading desk, on my station there. So I'll do it, and next week we will see what happened. Okay, of course I'm going to put a stop loss and a take profit. My take profit will be at 2060, and let's see next week during the webinar if I was right or most of the other analysts were right. I'm not saying I'm always right. I'm just saying that there is a higher chance that this goes up based on the information that I see and based on a market maker thinking, rather than this is a overcrowded market, it has to come down. This is what this person is saying. I'm not going to say the name. Okay, and that's it for today. Next week we will also let's go back just to the PowerPoint slide so that we see what we're going to do next week. Okay, so next week we're going to see reversal strategies. Okay, first of all, we're going to do a little bit of trading as well. We're going to learn how to spot reversal strategies. We're going to learn how to spot breakdown levels. Okay, so actual looking at the charts and spotting opportunities, and candle signals. Okay, so powerful strategies, episode 6. That will be next Wednesday on August 26th at 4 p.m. I hope to see you there. Thank you very much. Again, I'm so sorry. If you have any questions, please feel free to ask before I turn this off. I was about to end the webinar. Please feel free to ask any questions if you have any. Thank you, Karim. Okay, so I hope this was informative again, and I hope to see you again next week. Thank you, guys.